welcome everyone to this special live online event co-hosted by ICMA and IHS Markit, looking at the Asia-Pacific credit markets in the wake of the COVID-19 crisis. I'm Andy Hill, Senior Director in ICMA's Market Practice and Regulatory Policy team, and I am responsible for ICMA's secondary market work globally. The market turbulence created by the COVID-19 pandemic is quite unique as global financial crises go, in that not only did we see levels of market volatility and price dislocations comparable with those experienced in 2007-2009, but this also occurred in an environment of geographical lockdown, where traders and investors were largely restricted to working cases from home. This was not unique to the APAC region and was largely a global phenomenon. And it will be interesting to draw parallels with observations and lessons learned from credit markets in other regions, such as EMEA. To discuss how the APAC credit markets adapted and performed during the crisis, I am pleased to be joined by Sage Patel and Gavin Nolan of IHS Markit. Sage is Managing Director, Head of Pricing, Valuations and Reference Data for the Asia-Pacific region. Over the last 9 years, Sage has been responsible for driving IHS Markit's expansion into the APAC fixed income markets, more recently expanding his responsibilities into their derivatives business. Gavin is a specialist in credit markets and is the Director responsible for business development, also co-heading research for fixed income pricing at IHS Markit. Gavin is a published author and has written about the credit markets from the accounting scandals of the last decade through the financial and European sovereign debt crises. I am delighted to have both Sage and Gavin with us today. Before we start, just to make you aware that we want to make this session as interactive as possible. And I do encourage you to submit questions for Sage and Gavin as we go, and we will aim to spend some time answering these later in the session. We will also hold 2 polling questions to help frame the discussions, one at the start and one at the end. And again, we encourage you to participate in these polling questions. So we'd like to ask participants, what is your biggest challenge in the credit markets today? Is it liquidity, valuation, the impact of monetary stimulus, regulatory burden, or operational challenges, working from home and with more fragmented teams? So please press your appropriate buttons. Okay, and then we go. Perhaps not overly surprising, liquidity edges it over the impact of stimulus, but also the operational challenges are quite significant along with valuation. And interestingly, the regulatory burden is last on that list. Okay, that's helpful in I think framing where people are at in terms of their interests. So, Sage, Gavin, I'd like to kick off with the first question, and really this is a scene-setting question. And what I'd like to do is look back prior to the COVID-19 disruption, say over the last 12 to 24 months, and ask, what do you see as being the discernible trends and patterns in the APAC credit markets and the dynamics shaping the market during this period?
Thanks, Andy. It's Sage here. So look, a very interesting poll and the results. So look, firstly, I'd like to thank the ICMA for inviting Gavin and I to share our thoughts on, quite frankly, very extraordinary times that we lived through. As we all know, these credit markets that we see have gone through some incredible skews, some stresses, the volatility, and that's, needless to say, you know, the impact that's taken on people's lives. So in answer to your question, I think there's a couple of themes that have come through in recent times. Firstly, again, coming back to the poll and how the audience have deemed this, is really around the growth that we've seen in Asian credit markets. Asian credit markets have grown at a huge pace over the last couple of years. We've seen a number of Asian investors moving into the Asian markets, increased allocations from fund managers, which obviously has helped develop the drive and the growth for the market. And one thing that I should also say is that the other point is quite interesting, is that while there has been a lot of regulatory burden that's been placed on EMEA and the Americas, what we have seen is that there has been better, or should I say, the adaptation of any of the regulatory drivers into a local market here, and how local jurisdictions have really created their own nuances of those. And these obviously have had headwinds because, again, touching on the poll point, the liquidity challenges that we've had, lack of price transparency, and of course, adapting to these regulatory headwinds that have come through. So I think that sort of sets the scene as to what we've seen taking place within the Asia credit markets and some of the key drivers, especially over the last couple of years. I'll hand back to Gav, and if Gavin, if you've got any points you want to add to that.
Thanks, Sage. Yeah, I would certainly concur with all the points that you outlined there. I think, from a more macro perspective, I always find it useful in terms of any crisis to look at what the IMF says immediately before the crisis, because I think that gives a view of the conventional wisdom amongst the macroeconomic community, the establishment view, if you like. And if you look at their January 2020 World Economic Outlook, it was titled Tentative Stabilization, Sluggish Recovery. And I think that speaks volumes in terms of how things were viewed at the start of this year, given what had happened in the previous 2 years. 2018, we saw quite a difficult year in some respects in terms of geopolitical risk coming out of the Eurozone, the rise of populist governments, and this was having a knock-on effect globally. So, the Asia-Pacific region certainly not spared from that risk aversion. And we also saw ratcheting up of tensions between China and the US, which inevitably had a knock-on effect on credit markets and credit risk. Then in 2019, we saw a pretty steady recovery from all that widening that we did see in 2018. And in some respects, we saw a dislocation between the real economy and the financial economy. And that's obviously something we're seeing in much larger extent at the moment. So, spreads have been grinding tighter going into this pandemic. The risk appetite was quite high. Default risk was low. So in some respects, we're in quite a stable place as the IMF outlined. But there's always black swan events, if you like. Some people would say this pandemic isn't a black swan. There is always concern about a global pandemic and the effect it could have on the global economy. But really, we were in a relatively stable place in credit markets. And as Sage said, the Asian credit markets had been growing and being the open economies that they generally are, we're benefiting from some of the stabilization that we'd seen in Europe and North America.
So we were in a pretty stable state. We're looking at growth in the market. Then COVID-19 hit. Could you talk us through how this developed from the perspective of the market and what impact it had on the functioning and performance of the APAC credit markets?
Yes. So I think if we just look at the performance, first of all, so you can see in the slide, we can see credit spread performance in APAC. So this chart here shows the asset swap spread, so a pure measure of credit risk on bonds. And this is the market's iBox US dollar Asia ex Japan corporates index. So a pretty good benchmark for corporate credit risk in Asia outside of Japan. And you can see the recent spike in spreads as credit risk blew out, if you like. But if you look at it in context, it's certainly, when we looked at the peak, which was March 23rd, as it was across the globe, at that time, it certainly looked like it was going to be on a scale of the global financial crisis. Liquidity, which I'll come to in a minute, was seriously impaired in a way that was probably in some respects worse than great financial crisis. But it was capped out at that level. And if you look at it historically, you can see that the rise in spreads around 2011, 2012, that was really triggered again by risk outside of APAC primarily, particularly in the Eurozone. Around the time we had the Eurozone debt crisis and obviously the problems in Greece that were spilling over into the periphery of the Eurozone at that time. So we can see that we've since had a nascent recovery, which we'll expand on a bit later, in APAC. So if you look at this index, it peaked at around 467 basis points, which was on March 23rd. It was pretty stable. So that stability that I was speaking about earlier, you can see that in the spread performance last year, when it was trading in that sort of 200 to 250 basis points range. No volatility really, very low volatility. But then we saw this very recent spike in volatility. So that's the performance. So you can see it's definitely an impaired performance, but nothing too dramatic. And we'll come to the reasons for that in a minute. But if you look at the functioning of the market, I think the next slides show some quite serious developments as well. So this is the spike in volatility that I referred to earlier. This is actually the synthetic credit market. So rather than the cash, which we were looking at just now, this shows the performance in the synthetic credit market. And you can see the light blue line is the China sovereign CDS. So you can see a spike early in March. Obviously, China was the center of the pandemic, and earlier certainly was affected much earlier than any other country, but recovered quicker as well than the corporate credit, which is represented by the other lines there, recovered quicker. But in terms of the actual functioning of the market, those indices that we were looking at there and the CDS market, the synthetic CDS market, actually functioned reasonably well during this crisis. So this chart here, this shows liquidity. So proxies for liquidity, we're looking at the bid-ask spread, the actual notional traded and the amount that's been traded. This is actually from our MarkitServe subsidiary. You can see that the cost of providing liquidity, which essentially is the bid-ask spread, clearly did widen out as the pandemic exploded globally. So that there was certainly an effect on liquidity. But then if you look at the volumes, which are the two lower charts, so the gross notional and the trade count, we can see that volume spiked up quite dramatically in early March. There's always a spike in volumes in CDS indices around late March and late September because there's a semi-annual roll when they roll into the new on-the-run series. But this happened way before that. The reason behind that is these really are the instrument choice for macro credit hedging. Liquidity is very strong. It's proven in previous crises. Many investors will reach for these indices when they want to hedge credit risk or even synthetically take a directional view. And that has proven yet in this crisis. So that's definitely a positive to take from this. I think investors can rely on CDS indices to trade through pandemic crisis such as this or any other crisis for that matter. If we just look at the next slide, you can see things were different in the bond market, undoubtedly. So we've seen a big impairment of bond liquidity globally and in APAC. If you look at this table here, it does show that this is actually the liquidity scores that we produce. We rank bonds from 1 to 5, 1 being the most liquid, 5 being the least liquid. And you can see that this is actually the liquid portion of the market as well. So we're looking at bonds that trade regularly. You can see that the bonds with a score of 1, very liquid, 94% in most of the months preceding the crisis. And then you can see it drops dramatically in March to 80%. There you can see liquidity in the form of the depth of the market really suffering as we went into the crisis. That happened globally, and it certainly happened in APAC as well. So without a doubt, you can see quantitative measures that show liquidity, bond liquidity was seriously impaired. That was the fear going throughout the last couple of years, that would poor bond liquidity exacerbate financial crisis, and we've sort of proven really that has been the case to a certain extent.
I think just one thing to add to Gavin's points there. If we look at the behaviour of credit spreads in today's market, obviously we've seen a pullback from the stress that we'd seen not even a month ago. A number of participants within the credit space here, and especially in Asia Pacific, are really have their eyes on a couple of things. I mean, firstly is just looking at the level of the recovery that is being forecast coming through. Quite frankly, we're seeing a horrific announcements of varying economic data, which obviously is pointing to the recessionary pressures that are coming through the region. And obviously when the supply chains and any recovery, when that will take place. And again, estimations are that, once we see that, we will see the return of the growth that APAC has forecast. But again, that's very much in the open. I think there's another point that seems to be bubbling away, and I think Gavin alluded to that. The impact on credit spreads in APAC are really going to be driven also by some of the macroeconomic trends and that are taking place. And namely, there's clearly the resumption of the trade hostilities between the US and China. So again, that's one to watch as we progress through this cycle now.
Thanks. I'd just like to pick up on the points you made around the cash bond market and how we saw liquidity erode in cash bonds. Could you say a little more about the difference between how the derivatives market and the cash bond market reacted, and did some products perform better than others? And can we point to any dislocations between the two?
Yeah, I think that's certainly a very relevant point. So, as I just outlined, I think CDS indices are very much clear winners, if you like, in terms of proven instrument for taking on credit risk or hedging credit risk. Liquidity is held up pretty well in all given the circumstances. Bond liquidity certainly suffered, and that will definitely cause dislocations in terms of how these credit instruments, whether they be cash or synthetic, how they trade and the relationship between the two. So if we just move to the next slide, you can see a demonstration of this. So this chart here, it shows the CDS bond basis, and specifically it's actually a ratio of CDS bond basis, so it's not measured in absolute terms in basis points. So anything above 1 is what's called a positive CDS bond basis, where CDS spreads are trading wider than the equivalent bond spreads, and anything below 1 is indicating a negative CDS bond basis, so bonds trading wider than CDS. So you can see, and this is actually the financial sector I'm looking at the moment, so it's not a macro view, it's specifically financials. And you can see, if you look at the regions, as well as the Asia region as well. So if you look at Asia ex Japan, North America, Europe, going into this crisis, a consistent negative basis, which is pretty typical for the financial sector. Then you can see as the crisis hit, there's a clear effect where the negative basis becomes even more acute. And that's something we have seen in previous crises. And that comes back to some of the issues that we were talking about in terms of liquidity. So I think with low bond liquidity, you're going to exacerbate the spread widening when there is much more risk aversion, as we're seeing in this current crisis. And that will cause the basis to become even more negative. And also funding costs as well will affect the ability to trade bonds and hold bonds, which again is factored into the risk of holding a bond. So that again, that's driving that negative basis. It could create opportunities for some investors if they're able to put on those negative CDS bond basis trades. So that would be actually buying the bond and buying protection through the CDS market. But obviously there's transaction costs related to that as well. And if liquidity is being impaired, it can become quite an expensive trade. But we know there are some investors looking at that area again. But it's interesting to see that Japan's very much an outlier here. So they had positive basis anyway, but it became even more positive as the crisis hit, which was very quite unusual. And I think it speaks to the relative liquidity in the single name market in Japan on financials. And also probably some of the actual central bank policies in Japan as well, affecting bond liquidity. So I think that gives you a pretty good, it's an interesting take on what's been happening in CDS relative to bonds.
Yeah, Andy, I'll take another sort of angle on this as well. I mean, to some of the strategies that are being implemented post or during and post these challenging times. One thing is very certain is that investors have been looking closely at how they're managing their credit risk. As I mentioned earlier, that this is a topic that isn't new, but as credit markets are trying to better manage its risk, given the strategies, the skew, the stress, and obviously given the growth of the regulatory sort of headwinds that are coming through, investment decisions now are really looking at tools which will give them the comfort, the confidence to access these markets and better understand the market risks that they, that they will take on. I can't see this going away. I mean, I think if anything, this is going to be an increasing theme, outside of, the direct transactional of credit markets. I think most regulators have, in region and again in Asia Pacific, have been very firm with the directives and the timelines that they laid out for implementation of the varying rules, whether it be the Basel related rules, the accounting standards. So I think that's something that, given the backdrop of obviously the volatility we see and the liquidity challenges that APAC has always had, I think that's something that's going to be constant, and there's absolutely going to be a need to adopt and align against best practices and look at what tools are available, whether it be from deeper credit data, expanded credit indices, that will help support the next stage of the recovery and ultimately the growth that we will see, or everyone's forecasting for credit markets when we get to more stable conditions post the pandemic.
I guess another thought that certainly on my mind, and I would imagine many of the participants, if you were to compare what happened in the APAC credit markets and the observations that you've described so far, how would these compare with the US and European markets through the crisis? And what are the similarities? What are the differences?
I think I'll just quickly jump in there before I hand over to Gavin. It's clear that the APAC markets reacted earlier. I think the increased cases of the COVID-19, began to make headlines towards the end of last year. And with spreads widening and lockdown measures being discussed by governments across the region, I think now, the move to what the recovery looks like, and especially, if we look at the Chinese markets or Chinese credit markets, it's evident, from the most recent PMI results for services in China that they're showing the expansion. However, that should not undermine the view that there is significant credit risk that's being run within the region. The default risk that's been highlighted by some of the points that Gavin mentioned, and within the data that we see in our CDS data, is very clear that the market is still very much on tenterhooks. Once this obviously moved into a more global pandemic, it really did accelerate some of the spread movements and the volatility that we did see. I'll hand over to Gavin, and I think he can comment on a few of those points as well.
Yeah, thanks, Sage. I would definitely agree with most of that. We did see the spread widening react faster in Asia, clearly where they were at different stages of the pandemic. But the widening was fairly modest. It was only really accelerated when it became global. And that's clearly a reflection of the fact that Asian economies in general are very open economies. They're export-led. they have lower rates of consumption compared to some of the developed economies in Europe and North America. So they're very much dependent on that demand for exports from other regions such as Europe and North America. So clearly when those economies went into lockdown, it was going to have serious credit risk impairment on those exporters in Asia. And to some extent, I think clearly recovery is also going to be dependent on that as well.
Well, it sounds as if we've come through the worst, and I'm already, as you described, seen a significant retracement in credit spreads from the peak of the crisis wides. You've touched on some of the factors driving this. Could you elaborate a little more on what's really driving this bounce, and I guess quite importantly, where do you see the credit markets going from here?
Yeah, I think I can jump in there. Clearly, the bounce has been driven by the policy response primarily, in my view. I think it's been good to see very aggressive and assertive reactions from policymakers, both on the fiscal side and on the monetary side. If we're comparing regions, clearly the Fed in the US has taken a more aggressive response than Europe in general. They've expanded their balance sheet much faster. Although we did see the ECB yesterday increase its pandemic purchase program pretty dramatically. I think there was an overall view from many that the ECB had been a little bit tentative, been focusing much more on liquidity to the banking sector. And that's just really a reflection of the relative weakness in the European banking sector. So I think policymakers are, in the main, very concerned about this spilling over from a liquidity to a solvency crisis in between European banks. So that's what they've been trying to prevent. In Asia, the Bank of Japan has always been quite an aggressive in its monetary policy in recent years, and they've continued that. You could argue about how effective that is. I think we're looking at another deflationary scenario in Japan as well, but they've certainly been very aggressive in asset purchases. And there's also a view in terms of the shape of the recovery. So you've been hearing lots of talk about this alphabet soup of recoveries. I think the market is coming around to the view that a relatively V-shaped recovery is becoming the more likely outcome. Clearly, there's huge risk to that view. We could easily see any number of factors derailing that. We spoke about the fiscal response recently. I think if that stimulus is withdrawn prematurely, you could see a scenario where demand doesn't pick up as quickly as people think. In terms of consumption, there could be a much higher rate of precautionary saving, particularly if unemployment spikes up when some of the furlough schemes, for example, have withdrawn. And that would clearly affect the shape of the recovery and become much slower. We could also see the rise in corporate defaults that we spoke about earlier, which will obviously have consequential effects on recovery. So there are definitely some risks out there. But in terms of some of the similarities, you can see that if you're looking at this chart in front of us here, again, this is some of the cash bond indices that we produced from our iBox family. You can see that in general, Asia ex-Japan corporates trade a bit wider than their counterparts in Europe and North America. I think that's a reflection of the fact that many of these countries that make up the Asia index are emerging markets, essentially. So it's quite natural that they would be trading slightly wider. Although I think in general, balance sheet quality in Asia is pretty strong. If we're looking at the high yield market, particularly in the US, there's clearly scope for much higher defaults in that area, particularly in the energy sector, which we've seen obviously the big drop in the oil price. So I think that there's certainly, it's encouraging that we've seen this nascent recovery, and there are reasons to point that it could be continued, particularly in the alternative data sets. but there's many risks out there that could easily derail it.
I was just going to say, I think the extremely valuable points there. The way I look at where we go from here, I think there's absolutely no doubts. The resumption of the supply chains is one thing, but obviously having an accessible market, whether it be in EMEA, the Americas, and even Asia to some extent. So the length of the lockdown is obviously clearly going to play on investors' minds over the coming months. There's clearly, the what if, and that what if is, should we have a second, even third waves, what the impact would be there to global credit markets. But one thing's very clear is that the way that investors, and especially in terms of their investment allocations is really looking at what are the best practices now that they need to evolve and adapt to. I mentioned, we were going through a fairly stringent regulatory drive within the region. I think that's obviously going to continue. But I also think that there's going to be more focus around the tools that are required to make these informed decisions with regards to their investment views. And that's something that, we've been working very closely with the market on. So that's the sort of landscape. I mean, again, we're still at the, dare I say it, I'm still at tender hooks, and there's a number of factors that could impact. Gavin touched on the Chinese-US trade war. There's obviously the election view that's coming through from the US, and which all are very, very significant in terms of credit impact to the local market here. And that's not even talking about some of the regulatory requirements that are being driven.
Yeah, I think that's exactly right. And Sage mentioned the length of the lockdowns, and this chart here I think is very pertinent to that. It's actually an IHS Markit containment index. So it's produced by our colleagues in economic and country risk, and they look at the severity of the lockdown measures introduced by governments. They look at school closures, freedom of movement, etc., and they rank countries accordingly. And you can see obviously the trend is, and they predict how these things are going to unwind. And you can obviously the trend is downwards, meaning that lockdowns are going to be relaxed. You can see the likes of India, very severe lockdown. The UK in Europe again has a more severe lockdown than most, and is to some extent struggling to come out of that situation. But these are very much hostage to fortune and hostage to if we see a second wave of the pandemic. As things do start to relax, are we going to see an increase in the infection rate? We don't know. I mean, it's the market has to price in huge uncertainty here. Even the world's most prominent epidemiologists and virologists don't really know. So this uncertainty is very difficult to price, and I think why a lot of investors, credit investors, are using instruments such as credit indices and also credit index options to try and hedge some of that volatility.
Thank you. I mean, it sounds, and we observe that that clearly there's a lot of optimism being priced into the recovery of credit markets. But underlying that, as you helpfully explained, a lot of unknowns and a fair amount of fragility. It'd be a good point, I think, to go to the participants and put a question to them, asking, what do you think is the biggest threat to the recovery in APAC credit? I can tell you what the options are. So again, the question is, what do you see as the biggest threat to the recovery in the APAC credit market? Is it 1, escalating US-China tensions, 2, a second wave of COVID-19, 3, premature withdrawal of central bank stimuli, and 4, rising corporate defaults? While you're doing that, I'd just like to remind people that if you do have any questions that haven't been answered so far, please do feel encouraged to put them in the Q&A box. Okay, that's interesting. It's a tie, roughly a third each of the responses. Escalating US-China tensions and a second wave of COVID-19. bit less concern, still around a quarter, an increase in defaults, and less concern, I guess a lot more faith in central banks these days in terms of stimulus. Yeah, we have a question. I don't know if Gavin or Sage, you'd like to take this one, but the question that's come in is, what do you think about the China domestic credit market and trends here?
I can start with that one. I think if we look at the recovery that we're seeing coming through China at the moment, is one that's very positive. And again, I think we touched on the point that we raised earlier. I think, with the exports that China has and has been pushing through, we need to have a function in an open market to really ensure that the trends, or should I say that continues within, the other regions that they supply. I think in terms of onshore credit trends, there's the continuation. I think this isn't anything that's new in the risk of defaults that are taking place. We've seen a rising default scenario that's taking place within China over the last couple of years. But again, within a reasonable containment, that can obviously change if there are any additional skews, volatility, a second wave, that could really sort of turn the corner, especially for a number of the corporates that sit within China. Gavin, I don't know if there's anything you want to add to that.
No, not really. I think you've covered it quite well, so nothing to add from me.
We have a related question, which is, clearly we have this ongoing US-China trade war. Do we see any chance of a US-China financial war? I guess that's really a question of opinion. I don't know if either of you have a strong view on that.
I wouldn't say I have a strong view, but clearly the elephant in the room to some extent is the US election later this year. So yeah, I don't think either China or the US have really anything to gain from a trade war or financial war. That'd be a lose-lose situation. So rationally, you think it shouldn't happen. But given that there is an election later this year, I think it's more than likely that we could see a ratcheting up of tensions even further. So in my view, that's certainly a very tangible risk. Going into the second half of the year, there's always scope for policy mistakes and things spilling over in unexpected turns. So it's a really, really strong factor, I think, in terms of if we see a risk reversal from the current rally. In my view, it's certainly one of the main factors.
We're pretty much up against the clock, but there was one question I wanted to ask before we close, and it goes back to the polling question and something you touched on already, which is the possibility of another wave of COVID-19. If we see that, how do you think the markets, the APAC credit markets, will fare this time? What do you think are the lessons learned from what we've had so far? And how will we get through another surge in the pandemic?
Yeah, I think that's in some ways the most important question. I think it's, to some extent, it is encouraging that some of those charts we looked at earlier, where we saw some of the credit deterioration that was curtailed by the policy response, both from governments and central banks. I think if they maintain that commitment, I think it can, if a second wave happen, it could, we could control it to some extent from a financial perspective. Obviously the big uncertainty, one of the main uncertainties, would governments be willing, for one, to keep maintaining fiscal support? Would they be able? Because we're seeing fiscal deficits rise to levels that we haven't really seen since the Second World War in some cases. So would they have that fiscal space to keep maintaining that stimulus. I think that is a major risk, and it also refers to some of the asymmetric recoveries that I was referring to earlier. So countries such as Italy, which had very little fiscal space going into this crisis anyway, would it be able to count on commitment from its fellow EU members to help it out in that regard? Again, we're seeing encouraging signs actually from Germany, but less so from some of the other EU members. I think in APAC there is quite significant fiscal space to maintain that stimulus. So yeah, it will really depend on the political commitment to some extent, and we could see central banks going into even more unconventional territory if there was a second wave.
Great. Well, thank you. We are actually right on time to close. It leaves me to thank Sage and Gavin for your insights, and I think it's been a fascinating session. I'd also to thank the participants for joining, and just to remind people that this will be available online and to download as well after well, hopefully pretty soon. So thank you again, Sage and Gavin, and thank you everybody for joining, and look forward to joining you for another online event pretty soon.